Good day to all. My name is Chloe, a senior research analyst from IFAS. Oil prices have recently reached their highest levels this year amidst growing expectations of a supply deficit. For instance, oil prices were up by nearly 30% in the third quarter after rallying since mid-June. Brent crude, a benchmark for prices, reached $95 a barrel in September, and supply curbs implemented by OPEC+, which includes a combined 1.3 million barrels per day voluntary cut from Saudi Arabia and Russia until the end of 2023, after both these countries had agreed to prolong their supply curbs by another 3 months in September. As a result of these production cuts, the market remains underpinned by ongoing supply concerns. In fact, the International Energy Agency, or IEA, has warned that the extension of output cuts by Saudi Arabia and Russia through the year end would likely result in a substantial market deficit through the fourth quarter. Meanwhile, oil demand is also proving resilient, and as available supplies lag behind this increase in oil demand, it could lead to a 2 million barrels per day deficit in the fourth quarter. To cope with the tightening oil supplies, global inventories are being drawn down, and this drawdown in inventories could leave the market exposed to further price spikes. Despite the higher oil prices and falling inventories, the private sector response seems to have remained contained so far. Looking at the US domestic oil producers, the US oil rig count, tracked by Baker Hughes, has failed to rise in line with prices and is even showing a decline lately. This is unsurprising as structurally, the oil and gas sector is a market that is defined by underinvestment. Corporates prefer to focus on capital discipline, and adding to this lack of desire for investment is the ongoing transition in energy markets to lower carbon fuels. More importantly, the recent rise in oil prices, it flies in the face of efforts to tame inflation. There's a possibility that we might see inflation spike higher in future as soon as the high base effects of energy prices witnessed in 2022 start to moderate or wear off. We are currently in a unique situation where, despite economic uncertainties, oil prices have remained elevated, given the relentless drive of OPEC+ to keep oil prices higher. Over the longer term, constraints on production coming from years of underinvestment will likely mean that oil prices will likely remain higher for longer. With this in mind, investors may wish to consider the BlackRock World Energy Fund or the BlackRock Natural Resources Growth and Income Fund, which has exposure to integrated players in the energy space who benefit from this higher for longer oil price environment. To get the full analysis, scan the QR code or click on the link in the description below. Next up, Timing will be doing a credit update on Metro Holdings. Over to you, Timing.
Good day to all. I'm Timing, research analyst with IFAS. Are you ready for a little financial adventure? Today we'll be talking about Metro, and yes, in case you are thinking of the 2 departmental stores in Singapore, you are on the right track. We like the Metro 4.3% maturing in 2024, which comes with a relatively attractive yield pickup compared to the Singapore T-bills. It's like choosing a juicy, ripe mango over a regular apple. It's not just about satisfying your investment appetite, it's about savoring every bite of those returns. In a time when high interest rates have ruffled the feathers of the real estate sector, Metro stands tall, holding its ground like an unshakable fortress. Metro, despite being more well known for its departmental store, is actually a real estate investment and development group, with 75% of its income coming from this segment, and 25% coming from the minor retail segment of departmental stores. Now, let's dive into the heart of Metro Experience, its retail and property segments. Picture this. The retail segment forms a sturdy, reliable foundation of profits. It's like having a steady hand on the wheel, navigating through economic tides. But that's not all. There is a hidden treasure here, the diversified property segment. Think of it as a multifaceted gem. Metro doesn't just rely on one source of income, it taps into various opportunities like a seasoned explorer. Even in the aftermath of COVID, when many companies saw their profits dwindle, Metro continues to see financial strength. That's a testament to its resilience, and this success story makes it stand out from other companies. What makes the Metro 4.3% maturing in 2024 offering alluring? First off, it's the short tenor, which means that you won't have to lock away your funds for too long. But it's the good yield pickup over the 6 months T-bills that is truly captivating. In other words, your investment won't just sit idly, it will grow and flourish. So why Metro over similar issuances? It's simple. Metro has carved out a niche for itself, striking a harmonious balance between short tenor robust use, and a resilient credit profile. Beyond just an investment, it's a good opportunity for those seeking yield pickups from a stable company. In conclusion, if you have been pondering your next financial move, the Metro 4.3% maturing in 2024 is an idea that's worth exploring. It's the Metro ride that promises not just 2 departmental stores, but a whole world of financial possibilities. So hop on board and let your investments flourish in the ever-resilient Metro landscape. Your financial adventure awaits. To get a full analysis, scan the QR code or click the link in the description below. That wraps up for the sharing of this week. Catch us again next week for more investment ideas and updates.